Good morning. It's Friday, the 16th of August, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. Our top themes for the day, and we don't have a take today. The markets are waiting for interest rate cues from the US. The top 26 fund houses in India are sitting on nearly 80,000 crore rupees in cash, up 27% from the previous month. Why India's steel industry could be headed for more trouble. India's import bills rise as the Russian oil honeymoon conclusively ends. From speciality hospitals to contract manufacturing, why big investments are flowing into Indian healthcare companies.
This is a core report with Govindraj Ethiraj.
Markets wait for US interest rate cues. So the stock markets at large, which means India and the world, are now on standby for an interest rate cut by the Federal Reserve in September, as much promised, discussed, debated, but never happened, and of course in the last few months. Now back home on Wednesday, the BSE Sensex and NSE Nifty50 were both up, but only marginally, with the Sensex rising 150 points to close at about 79,105, while the Nifty50 was up barely 5 points to 24,143. The other word for all of this is flat. So nothing much to report basically, except that it's not going down. Top performers in the Sensex were TCS, HCL Tech and Tech Mahindra, while losers included infrastructure stocks like UltraTech Cement, JSW Steel, Tata Steel and Adani Ports. More on steel shortly. Top fund houses are sitting on cash. Now, deploying funds is never an easy task, even for an institutional investor, or perhaps most for an institutional investor. The obvious reasons is valuations, which are high and accepted as high by most for most stocks, which also means that buying stocks at a time like this is tougher, unless, of course, you take a call that clearly stretched valuations could stretch even further. But then, as an institutional investor, you're expected to be more careful and sharper than a day trader who borrows funds on an app and in most cases loses money as well. So, cash held by equity mutual funds jumped up in July after budget volatility and concerns about valuations. On the other hand, of course, the inflows into mutual funds, including via new fund offers, continues unabated. Equity mutual funds of the top 26 fund houses were sitting on nearly 80,000 crore rupees in cash. That's almost $10 billion at the end of July 2024. And that's up about 27% from the June end number of about 62,000 crores, according to a report from Motilal Oswal, quoted by Business Standard. Thanks to which, the aggregate proportion of cash in these schemes has risen to a 15-month high of about 5.4%, while in June it was 4.6%. So what are valuations looking like? So as of August 14th, the Nifty50 was trading at a 12-month forward price to earnings ratio of 20x compared to its 5-year average of 19x. I've ignored the decimals for now. The P ratio of the Nifty Mid-Cap 100 was about 32x versus a 5-year average of 24x. The Nifty Small Cap 100 was trading at a price to earnings of 20.6x or 20x compared to the 5 average of 17x. Tata Mutual Fund said in a note quoted by Business Standard that in price to earning terms, the Nifty50 is trading at a close to 90% premium to the MSCI Emerging Markets Index, above its historical average of 50%. Now, if you were to forget all these numbers, it just goes back to the same point that there is a lot of stretch in the valuations that we are seeing now. Now, to come back to the report, Parag Parikh Financial Advisory Services Mutual Fund, or PPFAS Mutual Fund as it's called, had the highest cash holding at 16%. So meanwhile, if you were looking for benchmarks, then Warren Buffett is obviously a good one. And as it happens, Parag Parikh, the late founder of PPFAS, was a disciple of Warren Buffett. Not that the latest numbers are influenced by Warren Buffett, at least at this point, but his Berkshire Hathaway had raised its cash position relative to total assets in the June quarter to 25%. And this apparently was a level last seen in 2005. Berkshire's holdings in cash and cash equivalents have reached a record $277 billion at the end of June, following also a recent selling spree in Apple and Bank of America stocks, according to Money Control. Oil prices fall. Oil prices have slipped somewhat after gaining last week following a government report in the United States which showed a surprising buildup for US crude stockpiles, according to Bloomberg, in something that we mentioned last week, or rather earlier this week as well. Brent crude is a shade above $80 a barrel, and we will talk about oil a little more shortly. The unexpected increase in oil inventories may depress prices over the short run, analysts told Bloomberg, saying the expected geopolitical risk will also probably return to the fore in coming days. US inflation data released on Wednesday was broadly in line with expectations, keeping the Federal Reserve on track to lower interest rates next month, something that we've already touched upon. And there are global projections to watch, though, and principal amongst them are from the International Energy Agency and the Organization of Petroleum Exporting Countries, whose forecasts vary at times. The International Energy Agency has flagged a global surplus in the fourth quarter if OPEC Plus proceeds with plans to restore production in October. OPEC Plus is currently obviously curtailing production somewhat. The OPEC had also trimmed forecasts for worldwide demand this year and next, citing downward revisions for China's outlook. And more on China in a moment too. All eyes are now on Iran and if it will launch a retaliatory strike on Israel. The United States has said that the probability of an attack has increased and that it could come as soon as this week, according to Bloomberg. Gold prices are inching up. Meanwhile, gold prices rose on Thursday, a day after US inflation data suggested that Federal Reserve might reduce interest rates next month, though the extent of cuts remains uncertain, according to Reuters, which added that spot gold was up slightly at about $2,458 per ounce, and that figure is just $25 short of the record high of $2,483 hit last month. India's import bill is rising, and thanks to oil. India's overall exports, before we come to imports, rose by about 4% in April to July, or the last 4 months, compared to a decline in the same period of about 13% in the previous year. Notably, textile imports also picked up pace and are likely to see further growth in coming days as some political unrest in Bangladesh, a big garment exporter, may lead to some shifts, a report from Bank of Baroda Research says. So the worry, of course, is now here. Imports on a cumulative basis have picked up at a faster pace than exports by about 8% versus a decline of about 14% last year. The increase, now this is important, is in turn due to a rise in oil imports to about $65 billion compared to about $54 billion in the corresponding period last year. In the same period, two things have happened. One, international oil prices have risen about 8%. And two, as we've been pointing out in the core report in recent months as well, the massive Russian oil discounts and thus the honeymoon is now going away. Bank of Baroda Research says that for the 3 months from April to June this year, the unit value of India's oil import from Russia is at about $609 per ton, which is higher than the $479 per ton seen in the same period last year. So, last year, we were paying about $479 per ton for Russian oil. Now we are paying, or we were just paying, about $609 to $610 per ton. Amazingly, and apparently it's now cheaper to import oil from Iraq at this point than from Russia. Now, this, of course, has some interesting consequences, which are more of a geopolitical nature, or at least should have, including on how we deal with Russia in coming months, at least on the aspect of oil. And more on that soon, but not today. Why India's steel industry is headed for more trouble. India's steel industry has been loudly complaining of low-cost imports from China and even Vietnam. Indian steel company CEOs have been saying that the Chinese factories were focused more on keeping those factories running than making profits. Well, they, and I think Tata Steel specifically, were right. Bloomberg is now reporting that the Chinese steel industry crisis, according to industry players there, is more serious than the downturns of 2008 and 2015. The crisis will likely be longer, colder, and more difficult to endure than we expected, the chairman of China, Baowu Steel, told at the company's half-year meeting, according to a statement reported by Bloomberg. Baowu produces 7% of the world's steel. Now, China's steel woes are linked in turn to the property downturn there, apart from weaker factory activity, which has led to falling prices. It's apparently increasingly unprofitable to make steel, putting mills under pressure to cut production. Exports are on course to top 100 million tons, the most since 2016. This is exports from China, some of which is obviously coming to India and also pushing prices down, which is in turn leading to steel manufacturers in India complaining. Meanwhile, iron ore prices, which go to make steel are also falling and now are back below $100 a ton and have fallen about 30% this year. India's healthcare sector is seeing a fresh round of private equity investments. So India's healthcare sector, a relatively newer investment avenue for private equity, is seeing considerable action. And in an increasing sign of the maturity of the space, is also seeing sharper and more focused investments, for example, in speciality hospitals. One private equity player is Quadria Capital, an independent healthcare-focused private equity firm with assets under management exceeding about $3.5 billion and investments in 18 companies across Asia Pacific. Quadria was founded by Abrar Mir, a former relegated capital markets and Bank of America Merrill Lynch investment banking group executive, and Dr. Amit Verma, a doctor and physician who earlier worked with Fortis on the business side. Quadria has said that it will deploy close to $1 billion, or rather over 8,000 crore rupees in investments in the next 2 to 3 years in India. Quadria is specifically interested in single specialty clinics, diagnostic companies, nutraceuticals, and contract manufacturing. So I reached out to Sunil Thakur, partner at Quadria Capital, which invests across Asia, like I said, and I began by asking him what kind of investments they were looking at, the size and the pipeline.
Well, quite a bit of it has changed in the last decade, or probably a little more than a decade. First and foremost, the scale of opportunity itself has grown multifold. Second, I think there has been a significant progress in institutionalizing the entire sector, especially when I talk about healthcare services, mainly to do with hospitals and diagnostics. Thirdly is the pool of capital that we are now seeing coming into markets like India, both from private entrepreneur side as well as from private equity side. And as you would know, significant part of investment that is required in countries like India comes from the private sector. And lastly, the market has matured quite a bit, both in terms of investing as well as in terms of providing avenues for exits across public markets, across M&A, across traditional sponsor sales. And then when you layer it with, very progressive policy, including how government is coming behind to support healthcare consumption through financing, as well as, setting up the right infrastructure on the primary care side. So all of it sort of are now coming together to provide a very conducive environment, both from a demand side as well as from a supply side. And that is what has changed significantly in the last 10 to 15 years.
Right. So I understand you're managing over $3 billion of assets and you're looking to deploy another $1 billion in the next couple of years, or rather 2.5 years. Broad sense on where this could go?
We typically mirror the market structure. So in a country like India, if I talk about 65% is on the services side, which is mainly hospitals from primary, secondary, tertiary care hospitals. And then about 20% in pharma. And then you have diagnostics, medical devices, and then associated healthcare services. So that's going to be the broad sort of deployment. But the way we bucket this, and if I have to share some percentages with you, roughly around 35-40% would go into the healthcare delivery services, about 30 odd percent will go into pharma, about 10-15% in devices, and the balance in associated healthcare services. And associated healthcare services for us would include retail, consumer healthcare, allied services like health insurance and stuff.
And if you were to look at your investments so far, including some that you're exiting, where would you say your returns have been the highest?
Well, I would say it's been secular. It's been sort of similar. If I talk about the big buckets, and the big buckets, if you have to keep it simple, healthcare services and pharma. So both of them have given us great returns. I think you have to choose some specific segments within hospitals and pharma. Single specialty has been a big winner for us when it comes to healthcare services. We have invested in hospital chains like HCG, AIG, and now have investments in Nephroplus, Maxivision. These are all single specialties. And then when it comes to pharma, again, it's about specialty pharma that we've invested in, have had some success there, as well as the upstream pharma, which is manufacturing, contract manufacturing. So we were invested in Concord Biotech, which we took public last year. And then we were invested in Akums Life Sciences, which is India's largest contract manufacturing company, which we took IPO just about 10 days back, and have had great success. And there are a few others in the portfolio, which we believe and hope will make a similar success for us.
Right. So what is the success of single specialty hospitals? Like you mentioned the dialysis eye hospitals, and then you said HCG, which I think is cancer. What does that reflect about the structure of India's health economy?
Oh, well, I would say very progressive, because as markets evolve and mature, the sector or the segments get federated, which means that various components of disease and clinical therapy starts to come out of hospitals and go very deep in terms of providing specialized services. And what it does is basically any form of specialization would galvanize deep capabilities on the supply side as well as bring significant demand for those specific segments. So if I talk about oncology specialty hospital or a gastroenterology hospital or a specialty hospital, you will start to see the supply side in terms of getting good clinicians who want to specialize in that particular vertical come together as part of that organization, because they get to specialize and super specialize in different components of that one particular disease segment. And that gives the capability and then also sort of creates the ecosystem to attract patients who are specifically looking for that clinical or therapy for that particular disease pattern. So that itself is a big reason why single specialty start to succeed, especially in markets that evolve and mature.
Right. So as you look ahead, Sunil, so though in the last decade things have matured, as in the industry has become more institutionalized and open to private equity and external capital, it's still, let's say, lagging other industries. So when you look ahead, can you say or highlight one thing that you feel the industry still lacks, which which is a sort of barrier to, let's say, investors like you? And what is the one thing that's working as you look for some of these opportunities to invest?
See, if I look at the opportunity, because that's the reason why we are here and we are here to invest, the opportunity set is huge. And I guess the challenges in front of the opportunity is minuscule. That's the way we look at it, possibly looking at it from a very optimistic lens. But opportunity is huge in terms of the need for capital, and it comes because of the gap in demand and supply. Demand, as you would know, we're talking about a population of 1.4 billion, huge disease burden, aging population, affluence, awareness, all of that creates a secular trend where we believe that this demand is for the next few decades. Whereas the supply, we are highly underpenetrated and highly under-indexed in terms of the basic infrastructure that we have for healthcare. And that sort of, throws up the demand, especially in a country like India. I think the challenges that we face are sort of similar to some of these adjacent industries. Mainly, it comes from the paucity of good talent and the size of the talent pool, both in terms of clinician, in terms of nurses, in terms of other specialists who are required to support the organization or, the sector. Second is, again, bulk of it has got to do with projects. You got to put up hospitals and, physical infrastructure. The speed of project execution, because you need multiple stakeholders to come together to, successfully put together a project. That has been a bit of a stumbling block. But again, things are improving quite a bit. And then, when it comes to segments like pharma, where outsourcing is a big model, big opportunity, there again, getting the confidence of international large pharmas to outsource large part of their value chain to countries like India, just the way it has happened in China. So it's improving. We are getting larger projects, but I think it will take some time before we get to the level or closer to, where China is. And lastly, it's about policy. So policy again has been very progressive, but again, for any private entrepreneur, they always believe that something better can always happen. So those are the four things I would say, remains a challenge.
So as you look ahead at your pipeline of investments, what are the prominent ones? I mean, maybe without naming names, but in at least the areas that you see coming to fruition in the next 6 months to a year?
We are evaluating quite a few deals, but none which is at a very advanced stage. We just concluded 2 deals from our new fund, which is Maxivision, India's third largest eye care clinic chain, and Nephroplus, which is Asia's largest dialysis chain. We are looking at opportunities across, again, single specialty. We're looking at specialty pharma. We're looking at some pharma services models and medical devices. So these are few areas where we are seeking out to invest in companies.
Right, Sunil, thank you so much for joining me.
Thanks, Govind. It's good talking to you.
And before we go, lots of feedback once again from all of you. Thank you for listening in and sharing your thoughts. Let me begin with a few. Anand Sharma says he likes the quality of questions, conversation, and the choice of topics. Would like to see more coverage of small and medium enterprises. Maybe take one small and medium enterprise from any sector and break it down from macro to micro. I do see a lot of feedback on this point, which is people asking us to break down. And I guess that's because we've been doing it in a couple of occasions. But Anand, thank you for that feedback, and definitely we'll pick this up. Ravi Verma says he likes the up-to-date market news and keeping it simple without any nonsense. Would like to see more coverage of emerging technologies. Dharmesh Madhwani says, likes the simplicity and information in the podcast and just continue the show the way it's going. Thank you for that, Dharmesh. And Sensitive Garlic says, in response to Pooja Mehra's podcast, which runs alongside ours, about how India's economy works, and he liked the episode featuring Shruti Rajagopalan and said that it was a great discussion and he's never heard, I'm guessing it's a he or maybe it's a she, never heard the pre-1991 economy described so succinctly before. And finally, here's our meetup announcement for today. That's Friday evening. We're hosting a small virtual meet with some of our newsletter subscribers and, of course, listeners of this podcast. The date is Friday, August 16th. The time is 5 p.m. Indian Standard Time. And we're meeting on Zoom, and the registration link is in the show notes. I look forward, or rather very much look forward, to speaking and interacting with you. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.